Rowe Price stock, ticker symbol TROW. This stock is down 47% year to date, which is quite a lot, especially if you compare it to the S&P 500, which is down 21% year to date. Rowe stock has a 52-week high of $223 and a 52-week low of $93. Right now they are slightly above this 52-week low. Current stock price is at $102. Rowe stock is loved among the investor because of the dividends. Dividend yield is sitting at 4.7% and is also growing in high amounts. But does this mean that Rowe stock is the best dividend growth stock to buy right now? In this video I'm going to show you real quickly what Rowe Price does, the historical returns, the fundamental analysis, dividends, competitors, and in the last part I'm going to give you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does Rowe Price do? Rowe Price provides asset management services for individual and institutional investors. Approximately 2/3 of the company managed assets are held in retirement-based accounts, which provides Rowe Price with a somewhat stickier client base than most of its peers. Rowe stock missed earnings big time on the 28th of July. EPS was missed by 35 cents and EPS gap was missed by 67 cents. Revenue was missed by 171 million, so this is something to keep your eye on. If we dive in the most recent earnings report, we see some key highlights for Rowe stock. Quarter-end assets under management of 1.31 trillion. Net client outflows of 14.7 billion. In total, TROW returned 476 million to stockholders, including 199 million of share repurchases. Revenue is down versus quarter year over year, but also versus the first quarter. This also has to do with the current market conditions. In this graph we see the investment advisory revenues. Equity and multi-assets are both down big time year over year, so this is something to keep your eye on. And now that we know more about Rowe Price stock, it's time to check the historical results to see what happened there. I decided to include the S&P 500 as a benchmark, since this is one of the easiest ways to invest. Just buy an S&P 500 ETF and wait. On top of that, I decided to include LPL Financial, ticker symbol LPLA, and the Nasdaq. On the 5-year chart we see that Rowe underperformed the S&P 500, but keep in mind that the orange line, representing Rowe, was above the blue line most of the time, representing the S&P 500. Except for the big drop beginning of 2022. LPLA and Nasdaq outperformed the S&P 500 big time. This returns includes dividends. On the 1-year chart we see that Rowe returned minus 48%, while the S&P 500 returned minus 16%. LPLA returned 38%, which is quite a lot, and Nasdaq returned minus 11%. On the 6-month chart we see a minus 25% return for Rowe, and a minus 13.8% for the S&P 500. Both LPLA and Nasdaq outperformed the S&P 500 big time. On the 1-month chart we see a minus 6% return for Rowe, versus the S&P 500 being nearly flat. Same story with Nasdaq, but LPLA returned 4%. So, Rowe stock is down big time and could be undervalued right now. So let's check the fundamentals of this stock to see its valuation. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe and in return you'll receive similar analysis to this one every week. Let's continue by diving into the fundamentals. Rowe Price is a 22.6 billion market cap company with a PE ratio of 9, which is of course very low in comparison with some other companies. But keep in mind that companies in this industry have a lower PE ratio in general. The 5-year PE ratio is at 10. Usually this could indicate that the stock is undervalued, but with these kinds of company we have to check a lot of other things as well. Trailing 12-month revenue is at 7.29 billion, and in this graph we see that revenue went up really nice and steady, which is something that I really like of course. But keep in mind that in the most recent quarter revenue went down, so this is something to keep your eye on. Net income is at 2.4 billion, which gives us a profit margin of 33%, which is of course very good. But again, keep in mind that it's lower than the 5-year average, which isn't a good thing. So definitely keep an eye on this number as well. In this graph we see that EPS is growing very nice and consistently over the years, but in the most recent quarters it went down, so this is also something to keep your eye on. And in this graph we see the price to sales ratio. It's declining a lot, most recently, which is because of the decline in stock price. So in general, this is a good thing. Right now, price to sales ratio is at 3.22 for TROW stock. Usually you want this number below 2, but since this is a different type of company, I think 3 is fine. And it's the same story with the price to book ratio. It's sitting at 2.5 right now, after the big drop in stock price, which is pretty decent for these type of companies. Price to free cash flow is at 7.46 and has been very steady and consistent over a longer period of time. So this is something that I really like. For these type of companies you pay a lower price to free cash flow in general. Analysts expect a nearly flat to low single-digit revenue growth for the coming years, which is of course a bit disappointing. And it's the same story with the EPS, flat to low single-digit growth. This is something that we have to use in the price target calculation later in this video. Next up is return on assets, sitting at 15%, so this looks all good to me. Return on equity is at 27.5%, also looking good. And the most important number here, return on invested capital, is sitting at almost 30%, which is very good, especially since it's up versus the 5-year average, so I really do like this number here. A thing that I do like a lot as well is the cash to debt ratio. Total debt is at only 307 million, while total cash is at 2 billion, so they can pay off all their debt with just a blink of the eye. And to me it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends, do acquisitions, research and development and a lot of things. And in this graph we see that free cash flow went up really nice and steady, except for 2016 and 2017. But right after that, free cash flow went up again. So this looks all good to me. Another thing that I really like about this company are the shares outstanding. It's decreasing over a longer period of time, which is very good, especially when the stock is undervalued. In the past 5 years they bought back roughly 5% of the shares outstanding. This increases your ownership, lowers the PE ratio, increases the EPS, and of course it will be easier to maintain and increase the dividends. And since we're talking about dividends anyway, dividend yield is sitting at 4.7%, which is of course very high. Annual payout is at $4.8 and payout ratio is at only 42%. For these type of companies I prefer a payout ratio of 50% or lower. Right now they have 58% left in cash to pay down debt, buy back shares, do acquisitions and a lot of things, so this looks pretty good to me. The 5-year growth rate is at 15%, which is of course very nice. They grew the dividends for 35 years in a row, which is pretty impressive. Overall, this is a great dividend scorecard. Next up are the fundamentals of TROW versus some competitors. I decided to include LPOA and the Nasdaq. TROW has by far the lowest PE ratio, so to me they are the winner here. Revenue growth year over year is the highest at LPLA, and so is the revenue compound annual growth rate. But to be honest, TROW did very good with double-digit revenue growth here. Net income compound annual growth rate is the highest at Nasdaq. TROW is doing very good with high single-digit growth. TROW has the highest gross profit margin and also the highest net income margin. Free cash flow margin is also the highest at TROW. Return on total capital is also the highest at TROW. And TROW is the only company who can pay down all their debt, so they are the winner to me. TROW also pays the highest dividend yield, but has the highest payout ratio as well. Dividend compound annual growth rate is also the highest at TROW, and so are the consecutive years of dividend increases. So to me, TROW is the winner here. Overall, I think TROW did very well. Of course there are some parts of the business that aren't performing as they should, but in the end I think they did very well. But does this mean that TROW stock is a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue, I expect things to slow down a little bit, same as the analysis. But I keep in mind that on the 5 and 10-year average they did high single-digit growth. For my low assumption I fill in 1%, for my mid assumption I fill in 3%, and for the high assumption I'm filling in 5%. Profit margin is pretty steady, so I'm filling in 30, 31 and 32%. Free cash flow margin I'm filling in 26, 30 and 34%. PE ratio is at 9.3, so my low assumption is 9. For the mid assumption I'm filling in 10, for the high assumption I'm filling in 11. It's the same story for the price to free cash flow. I don't want to overpay for a slow growing company. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now TROW stock is at $99. I hit analyze and we see a lot of green numbers. We have a low price target of $73 to $85, a mid price target of $100 to $104 and a high price target of $127 to $135. So if you believe these mid to high numbers, then TROW stock could be a buy. To me, the mid to high range is the most justified here, $100 to $135. My final conclusion on this stock is that there is not a lot of growth potential in revenue in the coming years. You won't see double-digit growth I think, but on the other hand you will get a nice and consistent dividend paying stock with some potential in stock price as well, since they are undervalued in my opinion. Right now TROW stock is representing roughly 3% of my total portfolio and bringing in some nice dividends. I have an average cost price of around $103, so it could be interesting to buy the stock at current prices. But to be honest, I think I will wait for the next earnings. It's expected that they will miss again the target, and with current market conditions, this stock could go down big time because of it. Of course, when they miss the target, I will re-evaluate this company to see if fundamentals have changed. But for now, I'm still bullish on this stock in the long run, and I hope the stock price will go down even more so I can enter at lower prices. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I'd really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.